It deals actually on the DTAAs, and where it refers to the contracting state from the alienation of immovable property referred to in Article 6, and situated in the other contracting state, or from the alienation of shares in a company, the assets of which consist primarily of such property, may be taxed in that other state. And that's now Article 13.1, which deals with the gains on that. Now, the above is extracted from the DTAA of most African countries. Now, holding company A holds shares in a property-rich company through its subsidiary, not tax resident in the contracting state, and this is where there is only assets. That is the only asset. That is the shares in the property-rich company is the only assets. Okay. In the event that the ultimate holding company of the group sells its shares in the holding company A, in which country are the gains subject to CGT? And then the question says, my thought process has been that no matter the layers of shielding, the fact that the underlying assets is property, CG is payable in the other state. Okay. So the general rule of thumb, if I can start with that, is that one must go and look at what do the treaties say and what does the domestic rules say for that jurisdiction in which the underlying property is held. Now, I can say to you that's the starting point, and another general rule of thumb is it's very seldom that you will be taxed on the sale of shares or of property other than in the country in which the property is based. Now, I'm saying it's the general rule. There are various exceptions, and each country has got its own specific rules. And when you're dealing with two jurisdictions and you are selling shares in the one jurisdiction, but the underlying asset is another jurisdiction's property, you could end up triggering taxes in the underlying country. In other words, and this is where it gets very interesting. So let me jump in there and interject myself and just start with the general interpretation of Article 13.1. So it allows the country where the immovable property is located, referred to as the other contracting state, to tax gains derived from the alienation of immovable property or shares in a company whose assets consist primarily or principally of such immovable property. Now, what is interesting about this, that one must go and look at the immovable property is the key factor for determining the source of the gain. Now, in a scenario, let's work on this. Company A, a holding company, holds shares in a subsidiary that owns immovable property in the other contracting state. Okay. The ultimate holding company sells its shares in company A. Now, you can see that's not even a company above company A in a different jurisdiction. The only asset of the group is the immovable property held by the subsidiary. So despite the fact that the sale is a transaction involving shares of company A, the provision in Article 13.1 targets situations where the assets of the company consist principally of immovable property located in the other state. And the intention is to ensure that gains on the sale of shares of such property-rich companies are taxed in the country where the immovable property is situated. As an example, to get very specific, if you take a country like Ghana, Ghana has got rules that specifically state that if you sell property in the country, and I'm not just talking about pure property, you're going to pay capital gains in that country, in Ghana. That's obviously if there's a gain. Okay. But if you sell the shares of the Ghanaian company and those shares are held by a foreign company, then you potentially could have a capital gain on the sale of shares. But even more importantly, you also have rules that are applied in Ghana where in any 3-year period, when there is more than where 50% or more of the shareholding or the underlying shareholding changes, you actually have to treat the sale of that 50% or more as a sale of the full fixed property in the Ghanaian company on a 100% basis. And then you rebase your new capital value of the asset, but you then pay the tax on it. So I'm just using that as an example. A few jurisdictions, as far as I'm aware of, have got these so-called clawback provisions where they actually go and look at the underlying sale, and that's over a certain period of time. Now, sometimes you'll have jurisdictions that will allow you certain corporate reorganization rules. And that's when a company's effective shareholding or ultimate beneficial or ultimate shareholder does not really change, but they change the structure, you could get the exemption of the taxes that are supposed to be paid because it's still the same owner. But if it's not the same owner, then you will have to pay. And certain jurisdictions, even if it is the same owner, you will have to pay. So it doesn't permit, or it's got quite strenuous rules. It's not possible to go and reorganize the group.